Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. I'm Audrey, Senior Cross-Asset Strategist. We've just released our global market outlook titled Inflation, a Flash in the Pan, where we discuss our views on the red-hot inflation print earlier this month and what this means for asset markets. Joining me today for this conversation is Steve Brice, our Chief Investment Officer. So Steve, welcome. It's been all about inflation in recent days after the big blowout in inflation print to 4.2%, the highest since 2008. And there's a big debate whether this inflation pressure is going to be persistent or transitory. What are your thoughts on this?
Well, we actually think that the Fed's got this totally right. So clearly there are some short-term supply bottlenecks out there, and there is a short-term shortage of labour, which is leading to upward pressure on wages. So we are going to see this inflation spike continue for 2 or 3 months longer, in our opinion. However, we believe the long-term drivers just aren't there for a sustained rise in inflation. So the unemployment rate is still pretty elevated, especially when you take into account those on the periphery of the labour market that could be attracted back given the appropriate opportunities. Productivity has actually been rising. It surged very strongly in the first quarter. So that's bringing the cost of production down, even with wages picking up. So that's a good thing for keeping inflation capped. And the final thing for us is that the money multiplier. So a lot of people talking about this huge money creation, quantitative easing leading to inflation. Of course, they've been talking about that since the global financial crisis, over 10 years ago. But what we're seeing is that the money multiplier, the speed at which money moves around the system, is still falling. So we don't believe that quantitative easing is going to lead to a rise in inflation. And we're seeing bank lending, for instance, remain very weak in the US economy. So from that perspective, we just think that this inflation is indeed a flash in the pan. Obviously, it's something we've got to weather in the short term.
But markets were actually quite spooked by the higher inflation print, right? Because we've basically seen, after the announcement of the sharp US inflation spike, we've basically seen equity markets as well as bond yields jump pretty sharply. So are you concerned at all that, further higher inflation print over the coming month may lead to significant equity markets or even bond market weaknesses?
I think there's always something to worry about. I always joke that if there's nothing to worry about, I get worried, right? So at the moment, the focus is on whether or not the Fed will taper. And that can be important for a short-term horizon. In Q4, we could be looking more at worries about the fiscal cliff, because obviously the end of the subsidies to employees will end come October. So the way we look at this is what is going to get in the way of the cycle, right? And we don't really see either of these things getting in the way of a continued growth cycle. So there will be bumps along the way. It's not going to be smooth sailing. And that, of course, can lead to short-term market weakness. But in the bigger picture, we still feel that this is nothing to be too concerned about. So, what we're sort of advising our clients to do is, to try to see through short-term weakness if and when it comes. Remember that actually not being invested is a cost. As well as being invested in markets weakening. And best ways to manage that is through regular saving plans or accelerating purchase on weakness, and obviously having a diversified allocation.
So how can investors position themselves for a higher or rising inflation scenario? Any specific areas one can be looking at, is it in the equity market or the bond market space?
Well, assuming that we're right and this is a short-term blip in inflation and nothing more sinister that would lead to very dramatic tightening of monetary policy, right? So against that backdrop, we see this economic expansion continuing on a multi-year basis. There's still enough excess capacity out there, in our opinion, for some runway for the economy to do well. And against that backdrop of continued growth, very loose monetary policy settings, then we think that the equities can do continue to do pretty well. I would say with the short-term risks always, but if you're looking 12, 18 months out, we believe that equity markets will continue to do well overall. So that's sort of the way we're positioning ourselves within bond markets. Yes, we're taking on a little bit more yield risk. So developed market high yield, for instance, and emerging market bonds, generally, particularly US dollar bonds, we think are relatively attractive. That sort of feeds into this growth outlook as well.
Thanks for that, Steve. Are there any specific equity regions that investors can focus on?
So we remain overweight or have the US and UK markets as preferred. And obviously, they were the initial beneficiaries of the vaccination wave, right? So that's where we see continued strong economic growth recovery, earnings growth recovery, and obviously still very stimulatory policy settings. This month, we've added Euro area to also being a preferred region for us. And there's three main reasons for this. Firstly, we see accelerated vaccine deployment. So, the pace in Europe of vaccine deployment is now faster than in the US and about on a par with what's going on in the UK. Clearly, that's a lot better than we were 2 or 3 months ago. So that's a positive development, and that's going to encourage economic reopenings. That leads to the second key factor is we're seeing earnings revisions being revised significantly higher. So we're seeing that earnings drive come through, and that should support the regional equity market. And finally, we see the dollar weakening. And generally, when the dollar weakens, non-US assets outperform, and Euro area is obviously one of those that should benefit from any dollar weakness that comes through.
So on dollar weakening, does that mean that that's good for gold?
So maybe I'll just cover quickly the dollar view as to why, and then the implications for gold. So firstly, we see the US economic exceptionalism as peaking, right? So it's almost as good as it gets for the US economy now, because we've had the reopenings, massive fiscal stimulus, huge monetary stimulus. And this pace of recovery, which is in the high single digit or low double digit from an economic growth perspective, that just can't be sustained. So whereas in Europe, obviously we're slightly later in that cycle. So the reopenings are starting later. And also we've got a fiscal policy stimulus coming in the second half of this year and into the beginning of 2022. So that means the growth differential between the US and Europe is likely to narrow. So, our sense is that the euro can go to sort of 127 on a 6 to 12 month time horizon. So the US dollar is also hindered by very loose monetary policies, real interest rates being under pressure, and huge trade and budget deficits. So our sense is that we should be selling rallies in the dollar rather than looking to buy here. And that obviously has a positive impact on gold. But the thing that we really focus on for gold, as well as the dollar, is the outlook for real interest rates. And again, with, inflation, still remaining, it's a blip now, but, we see interest rates and real interest rates remaining very low. That should be supportive for gold. So in our perspective, we think that gold may hit around 2,000, maybe slightly above $2,000 per ounce on a 12-month view. So we like gold. We think it's an important diversifier in an allocation as well. So from that perspective, it's something to consider.
Great. Thanks, Steve, for joining our conversation today. So that's all for today's episode of Standard Chartered Money Insights. If you would like to learn more or read our publication, please visit our website at sc.com under Market Insights. As a reminder, if you enjoyed our discussion, please do rate and review us whenever you get your podcasts. Once again, thank you for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.